Yeah, when you invest in the crypto asset class, you expect volatility. If I go back over all the years I've invested, most years you get two, three, or even four 30% drawdowns. This one in Bitcoin has been 27%. It's kind of within the range of normality. And what you need to ask yourself is the main drivers of crypto are the business cycle, i.e., where are we with the economy? Well, we're starting to pick up slowly. Inflation's coming down, rates are going to come down, liquidity is going to come in. And so, therefore, that's usually a very good time for crypto. So, the tailwind is behind you. And the other thing, are people adopting the technology? Are things being built on it? And that's ongoing too. So when you see a news event like the last few days, driven by macro factors, you tend to think they're likely to be short term.
Crypto fam, welcome back to the channel. That was Raoul Paul right there telling you you should be buying these dips. Don't be fearful. When the prices go down, you should be accumulating more Bitcoin, Solana, whatever crypto you believe in. And in today's clip, we'll be checking out Raoul. He's going to be talking about the fear in the market, Fed interest rates, his thoughts on the Bitcoin ETFs, and the United States will be putting Bitcoin in the strategic reserve. He talks about all that in today's video. I recommend you guys watch this one all the way to the end. And if you guys are new to the channel, please consider subscribing. Like the video. When you subscribe, it helps push out these videos to more people so they can learn about Bitcoin and crypto and start to eventually invest in Bitcoin, because you guys know that Bitcoin is the best asset on the planet, but we need to get more people into the space, so make sure to hit that like and subscribe button. But let's go ahead and check out what Raw has to say in today's video. Let's go ahead and play the clip.
Now, if the business cycle was getting old and the economy was starting to feel a bit more fragile, then yes, you might be worried about it. But this is early in the cycle, and generally you have to expect the volatility. And how I've always dealt with it is a Jedi mind trick, which is you look forward to it. When it happens, you can buy more, and you get to compound your returns much better than anybody else who just does nothing or tries to trade around it. So you should be thinking of these sell-offs as a gift. Is, oh, wow, if I can find a bit more cash, I can put it into the market. And you tend to do really well over the cycle by doing that strategy. So I don't think there is a lot to fear. In fact, I would be so outrageous to claim the probability of a down 50% market is now miles smaller than it was when you and I grew up, when it was a common occurrence that we would see it. We won't see this again because of the money printer.
Okay.
Doesn't mean it's a risk-free world, obviously, because when they print money, they're debasing your savings by 8% a year to start with. But if you think of that 8% cost of that debasement, that's like the central bank's buying a put option on the whole system, and it's costing you 8% premium a year. Put it that way, it's not the worst thing in the world, but it's never great. If we look at Trueflation, which is an on-chain, so on a blockchain, recorded about 1 million or so prices, it's a trusted source of truth.
Yep.
Now, it's not exactly the same measure as Fed inflation, but it's currently at about 1.5%. Now, inflation itself is driven by a lot of lagging factors, and housing is the big lagging factor, and wages, both of which are coming down. So we should see inflation much lower. Now, if I look at something called inflation break-evens, that's Wall Street's guess of where inflation will be in 1 year's time. If I look at it now on my Bloomberg screen, it's at 0.63%. So they're pricing in a massive undershoot of inflation. So it's telling us that rates should come down significantly. Right now, they're probably 100, 150 basis points too tight. And I think they should come down to probably around 2%, which is also very convenient because this year, the US Treasury has to roll $10 trillion of debts. And it's very expensive to roll it at 5.5%. It's a lot easier to do at 2%. So, I think it's a blessing, and the Fed will want to get rates as far down as possible for the next kind of 12 months when they have to roll all of this debt. It's like nobody wants to refi their mortgage at 5.5%. They want to refi it at 2%. It's exactly the same mechanism for the government because it costs you a lot. So we're exchanging a debt crisis for a slow debt crisis. The slow debt crisis is the printing of money.
Yeah, exactly.
So it's the 8% a year So over 10 years, that compounds at 100%. Yeah, if you think of it, if you think of most asset prices versus this debasement, the S&P is doing about 8% a year since 2012, which basically just keeps your head above water. The Nasdaq's done about 17%, but Bitcoin's been doing 150%. And when you look at Nasdaq versus Bitcoin, the Nasdaq is down 99.97%. So it does do very good for your purchasing power, but this debasement is a real issue because most things just don't keep up with the debasement. So you're right. We're not going to have a massive debt blow up. What we're going to have is this ongoing bleeding of all of our purchasing power. Volumes in ETFs are driven by two: net inflows, or people known as arbitrageurs who are arbitraging the futures market. So we don't know what that flow was. So they would sell the futures, which trade at a premium, and then buy the ETF. We don't know what that flow was, but let's assume it's net inflows because Binance saw record inflows yesterday as well. So what we're seeing is people, I think, because of the education that you've been doing, I've been doing, Michael Saylor's been doing, everybody's been doing, people are starting to understand the game. And even Larry Fink has been explaining the game. The game is the erosion of your purchasing power, not via traditional CPI inflation, but via this more pernicious debasement idea. And I think people are understanding and have been educated that this is a volatile asset class. And, as I started at the beginning of the show, is if we do get sell-offs, people are starting to realize that's when I buy. That same strategy worked incredibly well in the NASDAQ over the years as well. You've got a big secular trend, any wobbles, generally a buying opportunity. So I actually think it's a bit of a red herring because the US dollar is the world's reserve currency. The US doesn't need to hold other assets in reserve. Yes, it's got gold, but that was a legacy from leaving the gold standard. Other countries have to have reserves to support their own currencies, so they don't need it. Now, would they do it? I think it sounds flashy. For what reason, I don't really know. But let's assume that they do. Let's say I'm wrong and they do build something. It's kind of a weird world because, yes, obviously it's good for the crypto market because there's yet another buyer. But it's also weird because Bitcoin was set up to try and replace the government's control over money. And now you're inserting the government as one of the largest buyers of private money. I don't really like that, actually. But it's probably net positive for the crypto price. Now, maybe it pushes private use of money away from Bitcoin if that were the case. Because if the government can manipulate it, they could dump it onto the market, they can buy more, and before you know it, they're using it like they are interest rates in controlling regular money, and we don't want that.